All right. Hi, everyone. Thank you so much for taking time out of your Wednesday afternoon to join the session. I'm sure we'll have some more folks trickle in, but wanted to thank you all for coming. Today is all about tax planning for graduate students. I wanted to mention this is brought to you by the Johns Hopkins Federal Credit Union. My name is Shahar Ziv. I'll be your presenter today. Some of you may have joined one or two of our previous sessions, which were focused on investing and retirement. If not, those sessions were recorded and are available if you'd like to go back. Just a couple of housekeeping items. We're going to go till about 6:15 and then leave about 15 minutes, give or take, for questions. If you have questions as we go through, and I will say that I've done this a lot and I'll give you a bit of my background, but taxes for graduate students are probably very complicated and there are a lot of questions. Feel free to ask them as we go by using the Q&A feature. I'll do my best to answer them, kind of in real time. Some of them I may punt a little bit towards the end. And if for some reason I wasn't able to answer a question or you thought of something afterwards, you see here is my email address. Feel free to send me an email and I'd be more than happy to respond and give you kind of my thoughts. So with that, just to start, when you hear taxes, or when most people, let alone kind of students, hear taxes, probably is not the most inspiring or kind of passionate topic. If anything, it's pretty anxiety provoking. And that's because in the US, it really is a maze to kind of fill out your taxes. The forms are complicated and it's not very straightforward to intuit what exactly you need to be doing. So the goal of today's session is going to be to kind of break down some of that complexity and help you as you are trying to navigate tax filing season. We purposely did this early in the year, even though tax filing season only hits at the start of next year and needs to be filed by April, just because we know that there's a lot of anxiety about taxes and wanted to make sure that folks had information early so that you could kind of prepare yourself for that. So just to take a step back about the series, as I mentioned, this is the third in our three-part series. We started with a session on investing, we did a session on retirement, and today is all about taxes. And if you were here last time, you saw taxes are the number 3 item on topics in demand for graduate students after investing and selecting employee benefits. Before we dive into the content, just to kind of set expectations, some of you may know one of these two folks, Warren Buffett or Mellody Hobson. Warren is the chair, kind of CEO and chairperson of Berkshire Hathaway. Mellody Hobson is the CEO of Ariel Investments. In our 90 minutes today, I can't turn you into either of them. Today is all about building a toolkit for you and helping you kind of think of how do you decipher filling out your taxes as a graduate student. I'll give you some facts, mainly focusing on insights and strategies to kind of set you on your path. So just so you know kind of who I am, so you know essentially why you should be listening to me. Very passionate about personal finance. I do a lot of this at all levels, undergrad, grad, and early tenure employees. Most relevant for this audience, I have spent the past 6 years working with Columbia's Graduate School of Arts and Sciences, their master's and PhD students. And the session I would say that always has the most attendance is the one on taxes. Since then, I've also done this for NYU Stern PhD students and others. So I understand the questions and a lot of the concerns that graduate students have with their taxes. What I will say is, though, also, I'm pretty objective on this. I am not trying to solicit you to do your taxes. I can't do that. I am not a certified public accountant. I'll show you some disclaimers on the next slide. But I also don't have any conflicts of interest. I'm not trying to steer you towards filing your taxes in a certain way. I'm not giving you any sort of advice or recommending any products or services that I'm receiving compensation for. And that's a really important lesson, as I always say, in terms of getting any financial advice. Understanding, does the person have any conflicts of interest, and really making sure that you feel comfortable when answering the question, should I be listening to this person or not? So the disclaimers I mentioned, I have to put these on, and I usually do it just for the tax session. This is really meant for informational purposes. It's not meant to provide you with any legal or accounting advice. I'm not advocating for a specific tax treatment, and you can't use this to avoid paying any sort of taxes. Also, this is my opinion. This isn't the opinion of Johns Hopkins University or of the credit union, and they're not responsible for any of the positions that you take on your individual tax return. So I will be able to answer a lot of your questions. There may be some that, because they are very personal in nature or are about a specific part of the tax code, I may not be able to answer. And so at the end of the day, for those types of questions, you'll have to contact a tax professional or an attorney to obtain specific advice about your treatment. So apologies for putting these on, but I have to make sure that this is understood, kind of what this presentation is for, and also very importantly, what it's not for. So with that, let's kind of dive in. And I always like to start with a little bit of trivia. Gettysburg Address, for those of you who grew up or had a kind of a course on US history, one of the most famous speeches in American history, 269 words. Any guesses? Feel free to type it in the question and answer. Any guesses how many words are in the US tax code? I see 200,000, a million. Believe it or not, 7 million words. And this was a few years ago, so I'm sure it's grown. It probably is closer to 8, 9, or even 10 million. Also, Americans and people in the US, residents and non-residents, spend an exorbitant amount of money and time filling out their taxes each year. Think of where all of those hours and frankly, all that money could be spent probably in a much better way. So common questions that come up when I do this session: understanding who needs to file, what are all the forms that you're receiving. The number one question that I get is, what counts as income when I'm a graduate student? Number two question is, how do I offset some of that income with qualified expenses? For those of you who may be here from another country, there's a question of, are you a resident or a non-resident for tax purposes? And then there's all the questions around how taxes are calculated, what's withheld, and how can you lower your taxes. I will address all of these as we go through, and I'm going to try to do it in a pretty methodical way, kind of build up foundational knowledge. So look, why file your taxes? Number one, it's the law. You're required in most cases to file a tax return. You have to comply with IRS requirements, and if you're in fact, you may have to pay taxes that you owe, or you may be eligible for a refund. In addition, if you're an international student, it's not only compliance with IRS requirements, but it's compliance with immigration requirements in terms of filing certain forms. So at the end of the day, I've seen a lot of graduate students who actually get money back, but the only way in most cases to be eligible and to get a tax refund is to actually file your taxes. So let's start with the very basics. You earn income over the course of a calendar year, January through December, not the academic year. That can consist of salary, wages. It can be a stipend, fellowship, a salary for being a TA or an RA, interest and dividends on stocks or money that you have in a checking or savings account, etc. If you are working full-time for an employer, that employer may withhold some taxes, and those depend on a lot of factors, which we'll get into, and remit those directly to the government on your behalf. In other cases, you as an individual may need to make some payments over the course of the year, things that are called estimated quarterly taxes, and we'll cover that a little bit later. But basically, as the year goes on, sometimes either you send money directly into the government or an employer withholds money from your paycheck and sends it to the government on your behalf. And then once a year, usually in April, you can always get an extension, you file a tax return. And that tax return essentially reconciles the amount of taxes that were withheld or that you paid with the amount that you ultimately owe. And at the end of that tax return, you'll get, it'll spit out a result, which is you underpaid your taxes and you need to pay additional taxes, or you overpaid your taxes and you're owed a refund. So really that process of filing a return is just a reconciliation, looking at how much money you made and how much taxes you paid, and then looking at whether there's a gap or whether you overpaid. Oops. So key dimensions for tax filing, knowing that this is reaching a broader audience. One is whether you are a US citizen or for tax purposes considered a resident, or whether you're a non-resident for tax purposes. And there's also slight differences, but most of them don't really come into play. around whether you're a PhD or a master's student. Most of that is on the income side in terms of whether you're getting stipends or whether you are taking out student loans. But mainly your tax residency status will determine the types of tax forms that you fill out. If you're a US citizen or resident alien, you have to fill out a form called 1040 or 1040 EZ, which is just a simpler version of the 1040. If you're a non-resident, you fill out a 1040 NR, non-resident, or a 1040 NR EZ. If you're a postdoc, mainly I would think about it along these same dimensions. So if you're a postdoc, it's going to be the same thing. You mainly focus on your tax residency status, whether you're a US citizen or resident alien, or if you're a non-resident. And I'll explain those in a little bit in terms of what those differences are. Oops. So determining tax residency. Again, I know this is geared towards both a US and international student audience, so I just wanted to kind of start with this because it's a question that often comes up. Residents and non-residents. One thing to note, your tax residency status does not have to be the same as your immigration status. What do I mean by that? The US tax law divides people into residents and non-residents, and this is just for tax purposes. For tax purposes, residency is generally determined by something called the substantial presence test, and I'll talk about that a little bit later. And there's also some exceptions. But basically, if you are considered a resident for tax purposes, you follow the same rules as if you were a US citizen. You're also a resident for tax purposes. You're essentially taxed on worldwide income. If you are considered a non-resident for tax purposes, you follow a different set of rules, and luckily enough, you're only taxed on US sourced income. There are special considerations for students who are on an F1 or a J1 visa and their dependents. For one thing, you're exempt for a while from the substantial presence test. It does not exempt you from paying taxes or filing forms, but you're automatically categorized as a non-resident for a specific period of time. So you'll get this presentation afterwards, but here's a little bit of the cheat sheet. Essentially, if you're on an F1 and a J1 visa, and you've been in the US for less than 5 years, you will be considered a non-resident for tax purposes. If you've been in the US for more than 5 years, residency, then you most likely switch to resident status. There are some exceptions here. And then you can see some kind of other ones here. So if you're on an F1 or a J1 at the start, like you just go based on these requirements. Now, a lot of times, even this is hard to keep track of, and there's software that helps you do this. Now, I looked in based on Hopkins on the international student site, and I noticed that Hopkins has an agreement with Glacier tax software provider. And Glacier can help you both fill out your federal tax return if you're an international student, and it can also help you determine your US tax residency status. And so just to quickly walk through, Glacier can kind of help with that. It can also help you determine if you're an international student, if you are eligible for any tax treaty benefits, which I'll talk about a little bit later. So when you go on, you'll basically see that the first step is to actually determine your residency status. You'll put in information about yourself and basically talk about the country, yourself, your passport number. Importantly, it's country of citizenship and also country of tax residence. I've seen situations where people are citizens of one country, but are living in another country altogether before they came here. And so their citizenship and tax residence can be different countries. The tax residence is the one that's going to be important. And then you'll fill in all of your dates of arrival and dates of exit in the US and kind of the type of immigration status that you had. And basically Glacier will spit out to you what your tax residency status is. In this case, this person put in their information. I obviously blocked out the details, but they were considered a non-resident. And then it'll follow through in terms of applying all of those details. So I always like to start with that because I always often get questions from international students about how you determine your residency status. So let's start with talking about all of the forms that you may get and all of the forms that you have to fill out. And it really is an alphabet soup, but we'll start to decipher a lot of these as we go through the presentation. So a W-2 is one of the forms that you may receive. And basically this is given to you if you have kind of wages that you earned from an employer. So if you were teaching and you received essentially a salary, then you would receive a W-2. Now, this not only includes kind of a record of how much you earned from that specific employer, and you see in box 1, it'll have wages, tips, or compensation you received, but it also has how much money your employer may have withheld and remitted on your behalf to the government. And you'll see this in line 2 for federal income taxes, line 17 for state income tax. There's also other ones like Social Security and Medicare tax, etc. If you are working full-time, you will often receive a W-2, or if you have employment wage earnings, for example, a TA or an RA. And this applies, you'll get a W-2 both if you are a resident or if you're a non-resident for tax purposes. Now, there are other types of earnings that you could have. And that could be basically on forms called 1099 forms. 1099 miscellaneous would be for income that you earned as an independent contractor. Let's say you were an Uber driver or a freelance consultant. You can also get a 1099 INT, which stands for interest, or DIV, which stands for dividends. Essentially, if you earn money from a bank or a credit union savings account interest, you could get a 1099. If you have stock or mutual funds and you receive dividends, you can also get a 1099 DIV for that. One note here is that for non-residents, bank interest or credit union interest does not count as income and should not be reported. That's a nice benefit of being a non-resident. Now, when you get a 1099, you'll see, usually you'll have box 7 filled out, which is non-employee compensation. Now, what you'll also notice oftentimes is that when you get a 1099, those employers are not required to withhold any income tax from you. That means that nobody is paying taxes on your behalf over the course of the year. And that's really important from a planning perspective, because if you have a lot of 1099 income, you have to remember that at the end of the year, or basically quarterly, you're going to need to budget and make sure that you have enough to pay taxes on that money. It's not money that's withheld from your account to begin with. And you don't want to get into a situation where you didn't pay or kind of save up any of that tax money. And then when you file, basically you owe a huge amount in taxes. So really, really important to make sure that if you have a lot of 1099 income, you are at the very least putting some aside, knowing that you'll have to pay taxes on it. A 1098-T is another form that you may or may not get. Not everybody will get this. So if you aren't receiving it, no need to freak out. This is essentially a university sending to some students a report of how much expenses they had in tuition and kind of other education qualified expenses, how much was billed to you, and then how much how much in scholarships or grants were credited to your account over the course of the year. Now, I'll come back to why this is important when we get into kind of the calculations for graduate students. And then one form that you may receive if you are a non-resident for tax purposes is called a 1042-S. And basically, not everyone will receive this, but it's given if you have scholarships that exceed your tuition costs. Oftentimes, you'll also get this if you have tax treaty benefits, which I'll cover on the next slide. So basically, 1042-T is a summary for non-residents saying, what income tax rate you were taxed at. That's this line here, 3B, and some other codes, which I'll decipher for you in a minute. So a quick detour for non-residents. 68 countries have tax treaties with the US that affect positively your taxation withholding. And oftentimes these treaties grant benefits to foreign nationals who are in the US. The terms of each of these treaties varies. Glacier has those in its software. If you are bored and looking for some reading, you can also open up the IRS manual or Google it, and it'll actually have the details of tax treaties for each of the 68 countries. I don't wish that upon you, but if you want, you can do that. One example is that most non-residents can't claim dependents on their tax return. However, because of tax treaties, if you are a citizen of Canada, India, Mexico, South Korea, you actually can. That ends up lowering your tax bill. So Glacier or Sprint tax is another kind of one, basically help you determine eligibility for it. If for some reason you don't, or your tax citizenship status is a country that doesn't have a tax treaty, then you are subject to a 14% withholding tax on all scholarships, fellowships, and stipend payments. So if you have a tax treaty, oftentimes you're taxed lower, but if not, you're just subject initially to a flat 14% tax. Depending on kind of the type of income that you earn, you may see a different income code on that 1042S. And I'm not going to drain this slide. I leave it more just for you to have as reference material for later. Looking at what are the income codes that you may see on that form, what they correspond to, and a little bit of detail about them. So I'm not going to drain this one just because I know it doesn't apply to everybody, but you'll have this for reference material. Really importantly, if you are eligible, based on a tax treaty and you want to claim an exemption from US income tax withholding, you have to make sure the university knows about this. Otherwise, they don't know, and they're not responsible for going through each of you and saying, oh, this person qualifies, doesn't qualify. And so therefore, what is recommended is that you notify the appropriate university office of the fact that you're eligible. And essentially, you'll see the two forms there in terms of a W-8 BEN beneficiary and 8233, depending if you are, let's say, if you were driving for Uber, you would fill that out and give that into them. But for most of you, that W-8 BEN is the one that you really should be making sure you fill out and hand in to kind of the university, the appropriate office, like the tax office, to make sure that you are getting the exemption if you're eligible for it. Okay. One other form that you may see, and I call out here, is Form 8843. This is not an income tax form, but it's really important that if you are a non-resident for tax purposes, or the spouse of a non-resident, that you fill this out. And it basically documents the number of days spent outside the US. So even if you, for some reason, if your income is low enough that you don't have to fill out a tax form, if you're a non-resident, you still need to fill out and submit Form 8843. I've seen a lot of cases where people say, oh, you know what, my income's low, I don't need to file my taxes, and they forget about 8843. And that's really important to make sure that you do. Okay. So those are some of the forms that you may get. 8843 is one that you may have to submit. Now let's talk about some of the output forms. The 1040 is the basic kind of common tax form for an individual to file their tax return. And it's basically a summary of all of the of all the information in your tax return. Your personal information, any kind of deductions that you're taking, which we'll talk about in a minute, all the income that you received, and all of the kind of offsets that you're allowed. Now, depending on whether you're a resident or non-resident, you'll fill out a different version of this, right? Whether it's just the 1040 or the 1040 NR. But this is really the form that at the end of the day is what's submitted to the government. Now, if you are using tax software, which hopefully a lot of you are, people aren't necessarily filling this out by hand anymore, you'll answer questions in a different interface, and then a company like TurboTax or H&R Block, TaxSlayer will basically auto-populate 1040 with all the information you provided, and then you can submit the completed form. General timelines for this. The input forms, you really should be receiving those by the end of January. And if you haven't received it by really the start of February and you think you are entitled to it, you should reach out to the employer or the company that you think owes it to you. Usually in February, mid-February, the IRS begins accepting returns. Last year was a little bit delayed because of coronavirus, but usually it's around February. And then you usually have until the 15th of April to file your taxes. If that happens to fall on a weekend, it gets extended a little bit. If you, for some reason, cannot file your taxes by then, you can file an extension form that gives you until October 15th to file your taxes. The important thing to note about filing for an extension, if you happen to owe the government money, it doesn't relieve you of the obligation to at least make an estimated payment of what you owe by April 15th. So you can't game the system and say, oh, you know what, I'm going to file for an extension and pay everything by the 15th. Even if you don't know exactly how much you owe, you will potentially get penalized if you end up owing money and you didn't make any payments by April 15th. So just a quick call out. All right, this is the basic income tax calculation. And we're going to go through this in detail and use this as we talk about how you're going to complete your taxes. We start with gross income, which is all the money that you receive either from a W-2 or a 1099. It can be interest, capital gains if you sold stocks, royalties, etc. Basically all the money that's coming into you. And then you make some adjustments. Business expenses. If you're an Uber driver, let's say you made $10,000, but you spent $2,000 for gas. That $2,000 would be an adjustment as a business expense. Additionally, for those who attended the last session, if you're making 401k or IRA contributions, those would count as an adjustment and be netted out since those are pre-tax. All of that, once you make those adjustments, gets you to your adjusted gross income, which is commonly abbreviated as your AGI. Then the government allows some deductions. Now, there's two ways of doing this. The government basically says, you can go and calculate the specific amount of deductions that you're eligible for. For example, if you paid interest on a mortgage or kind of had other items or contributed to charity. Instead of making everybody itemize and do that calculation bottoms up, they say, we'll give you an option that just gives you an average deduction. And that's called the standard deduction. In 2020, it's about $12,400 if you're single, or $24,800 if you're married filing jointly. For 2021, it's $12,550, I believe, for single, and about $2,550 for married filing jointly. There are no more exemptions, and I'll talk about that in a little bit. But based on all of this, you basically get to your taxable income, and then you multiply that by your tax rate to get to your tax liability. So I'm going to come back to this clip in a minute. I want to kind of walk through a few more things, and then we'll take a short break in about 15 minutes. So in 2017, there was a big tax overhaul that passed during the Trump administration, and it influenced and impacted a lot of people's taxes in a few different ways. For one, it basically doubled the standard deduction. And you can see here how in 2017, it was only $6,000 or $12,000, and now they're up to $12,000 or $2,500. But it also eliminated the personal exemption. It created new tax brackets, which I'll cover shortly. And it also capped different deductions that were very, very popular with a lot of people. One is the mortgage interest deduction, and the other was basically deducting what you pay in state and local taxes. Often called SALT, state and local taxes. Basically cap the amount of deductions you can take there. On the state and local taxes side, if you happen to live in a state that had very, very high taxes, a lot of people there were actually able to deduct much more, and this kind of changed the calculus there. The tax brackets that went into effect and the US has are listed here, and essentially the tax brackets are progressive, meaning that you are not taxed the same amount on every dollar of income that you earn. Up until the $9,950th dollar that you earn as an individual, you pay a 10% tax. On that $9,951st dollar, you all of a sudden pay 12% in taxes, and you do that all the way through $40,525. So the more you earn and the additional money that you earn will get taxed at a higher and higher rate, depending on if you're filing as an individual or married filing jointly. And you can see that right now the tax brackets in the US go up to $523,000 or $628,000, above which any income above that you pay 37% tax rate. Let me say for all of you, I wish all of you to pay a 37% tax rate. It means that you're doing very well. But this is also, kind of one of the points that comes up where people get confused by something called your marginal tax rate and your effective tax rate. Your marginal tax rate is the tax rate that you're paying on the last dollar of income that you earned. So let's say you made $100,000. Your marginal tax rate would be 24%, because on the $100,000, you are paying 24% in taxes. Your effective tax rate, though, is basically, if you add up all of the amount that you have to pay in taxes and divide your income by it, that's going to be your effective or your average tax rate. By definition, your average or effective tax rate will be lower than, maybe equal to, but usually lower than your marginal tax rate. Here's just a very quick example of how to kind of calculate this progressive nature. Let's say you were filing as an individual, you were single, and you had taxable income of $45,000. On the first $9,950, you would pay 10% in taxes, or $995. And then on this second bracket, because you're still making more than this, you would basically find out how much money is within this bracket. So you'd subtract 40,525 minus 9,950, and you multiply that by 12%, which is this tax rate. And you can see that this would be about $3,000. And then finally, your income falls in this 22% tax bracket, and you're making about a little less than $5,000 of that amount that would need to kind of go in here. That gets taxed at 22%. And so on that, you pay about $984. So all in all, you're paying $5,000 plus in taxes. So now going back to my kind of marginal versus effective rate, you can see that your marginal tax rate is 22%. On that last dollar of income, you were paying 22% in taxes. But your effective or average tax rate would be calculated by taking all the taxes that you paid, the $5,000, divided by your income of $45,000. And if you were to do that, you would see that your effective tax rate is only about 11%. As I mentioned, that is pretty much always going to be lower than your marginal tax rate. This is a broader calculation just to show you a couple of different points. And this is for someone who is a US citizen and therefore is a resident. I picked someone who's in New York for a purpose. And you see two examples. So one who had household income of $25,000, and on the bottom, someone who had income of $50,000. So let's start on the top here. Basically, if you're making $25,000 and you're single filing in New York City, your marginal tax rate would be about 12% going to the federal government. Effective tax rate of about 5%. This is how much you owe. Now, if you happen to live in New York City and you're a New York resident, you would have to pay a couple other taxes. New York State has a state tax. It's actually not a pretty high amount, about 3% effectively. And New York City has a local tax, as do other cities. And so you not only are paying federal taxes, but you're paying state and local taxes as well. And then there's this fun FICA category. FICA essentially is contributions that go towards Social Security and Medicare. The way it works is that up until a certain portion of your income, you pay 7.65%, and your employer also pays 7.65%. And so that's another tax that can eat into your hard-earned income in a lot of cases. But you can see here that if you earn $25,000, you would end up owing about $4,500, and you'd have an effective tax rate of about 18% of your overall income. And the reason this is higher is because I'm also factoring in the state, local, and Social Security, Medicare taxes. Now, look what happens when your income jumps to $50,000. You doubled your income. What happens to taxes? They actually more than double. You're actually paying close to $12,000. And your effective tax rate goes up. So essentially, the more you earn, the more you'll end up paying in taxes. And it's not as simple as kind of a linear equation, partially because of that progressive nature of the tax code. So, one second, I see a question come in. Somebody asked, what's the difference between marginal and effective tax rates? So just to recap, marginal tax rates are the tax rate that you pay on the last dollar of income that you earn. It basically tells you, how high up in the progressive tax bracket are you going into. So in this example, someone who has taxable income of $45,000, their marginal tax rate would be 22%. Effective tax rate, think of it as the average tax rate that you're paying across everything. And so to do that, you would calculate you would take your total taxes paid and divide that into the taxable income. And you'll see that you're paying about 11% in tax rate. So your effective tax rate on your overall income is 11%, but your last dollar of income is getting taxed at a higher amount. So I'm going to take a quick pause here, and just to do a quick intermission, I'm going to put one of my favorite video clips from The Simpsons. Let me just, where is this? Well, I'm not sure. I'm just going to show this other one. Here we go. Just a brief interlude. Oops. Sorry, we have to get through our lovely ad here. I did this before, but I guess it added another ad. Apologies.
Oh, will this horrible year never end?
We've never lost a year before, and I'll be damned if we're going to lose one on my shift.
January 1st. Better get going on those taxes, Nettie.
Let's see, cash register ink. Well, that's a business expense, isn't it? No, but then I do enjoy the smell of this stuff, don't I? Better not risk it.
Daddy, what do taxes pay for?
Oh, why, everything. Policemen, trees, sunshine. And let's not forget the folks who just don't feel like working, God bless them.
Nettie, it's 8:45. The post office is going to be opening soon.
8:45? Here I am, yapping away like it's 8:35. Ooh, can't forget the mints.
Get your taxes out of the way?
No, just mailing out death certificates for holiday-related fatalities.
Listen up. The harder you push, the faster we will all get out of here.
Oh, Edna, you're certainly looking lovely tonight. Is that a new green sweater?
Until you're willing to file jointly. Back of the line, Seymour.
Yar, sometimes I wonder why I bother plundering at all.
Oh, no, I felt that. You didn't carry the one, you foolish person. Now you'll incur the penalties for the compound interest and the wrath and the truncheons behind.
This is Kent Brockman live at the Springfield Post Office on Tax Day. It's literally the 11th hour, 10 p.m., and tardy taxpayers are scrambling to mail their returns by midnight. Sir, why did you wait until the last minute to pay your taxes?
Taxes? Isn't this the line from Metallica?
Sir, why did you wait until the last minute to pay your taxes?
Because I'm an idiot. Happy?
Of course, not everyone is an idiot. Some of us took our receipts and pay stubs to our accountants months ago. And at the risk of sounding a little smug...
Oh, help! Does anyone have a calculator?
Myron?
No. Will you look at those morons? I paid my taxes over a year ago.
Dad,
What is it, sweetie? Did you see a scary picture in your picture book?
that was last year's taxes. You have to pay again this year.
No, because you see, I went ahead and year-wise, I was counting forward from the last previous... Oh!
I put the tax forms on top of your to-do pile a month ago.
I have a to-do pile? Marge, how many kids do we have? Oh, no time to count. I'll just estimate. 9.
Homer, you know we don't have...
Shut up. If I don't hear you, it's not illegal. Okay, I need some deductions. Oh, business gifts. Here you go. Keep using nuclear power.
Homer, I painted that for you.
Okay, Marge, if anyone asks, you require 24-hour nursing care. Lisa's a clergyman. Maggie has 7 people, and Bart was wounded in Vietnam.
Cool.
If I don't see it, it's not illegal.
Let's go help people.
All right, just a little interlude for those of you who know The Simpsons. I'll say a couple of things. This is pretty, pretty realistic too in many ways for a couple of reasons. So one, and I'll put the screen right back up. Take off this sharing. Yes, you have to file your taxes every year. Luckily, most of us don't have to go to the post office to do it anymore. We can do it online. But you have to file it accurately. And yes, you can take some deductions and expenses, but there are certain ones that actually increase your cost for an audit. And a lot of other kind of good, funny tidbits in there. But let's jump in and let's kind of focus in on what, I think the piece that's probably most relevant for all of you, which is, as a grad student, kind of what counts as income. There are all these different types of payments that you may or may not receive as a graduate student and as a postdoc and others. This is the summary form, and I'm going to go through each of these in detail afterwards, but this is a summary form of the type of payment, whether or not you will get a tax document, and if so, what kind, and whether different types of taxes are withheld, mainly federal and state, and also the Fica taxes. And then, kind of tax treatment for each ones. So again, this will be something you can reference, but just want to make sure you have this as kind of an initial summary view. What counts as income? Qualified scholarship or fellowship. So essentially, if you are receiving a stipend or a fellowship, and you are using that money for qualified expenses, you do not have to declare that as income. Now, this will apply and differ if you are a resident or kind of a resident from tax purposes or a non-resident. So starting on the resident side, big question that comes up is what does and doesn't count as a qualified education expense. So qualified expenses would be things like tuition, any enrollment fees, books and supplies if they are required for all students in the program. You can't say, oh, I bought this, great novel, that's a qualified expense. It has to be almost like listed on the syllabus or kind of, in documentation that the book is required. If you are, let's say, a science postdoc and you spend money on lab equipment and supplies, if it's required for all students, that would count. If you are a non-resident, unless you have a tax treaty, you will just have taxes withheld here at a 14% rate. It could go up even more. If you have a tax treaty, it's really going to depend. In some cases, you'll be able to exempt all of your income from this. Equally important is what doesn't count as a qualified expense. And if it's a stipend or a fellowship, some things that don't count: room and board, food and clothing, insurance and medical expenses, and the one that I think surprises the most people is student health fees. Those do not count as a qualified expense. Most travel does not. There are exceptions here. If there is a trip that is required for a course you're taking, that can count as a qualified expense. But a spring break trip or something that isn't a requirement for for a course, that doesn't count. Now, this is a part that gets a little bit tricky. The university is not required to report your stipend or kind of a qualified scholarship on any sort of federal or state form, especially if you're a resident. So if you're a resident and you received a stipend, that isn't going to be in any sort of tax form that you receive or that the government receives. That does not mean, just because there isn't a form, that doesn't relieve you of the obligation for accurately reporting and paying taxes on the appropriate portion. You may ask, how will the government know? In many cases, they may not. Unless you get audited or kind of ask questions, they may not. But do you want to risk getting in trouble with the IRS or with other kind of agencies because of this? So even if you're not getting a tax document for this, it's important to go through this process, and I'll show you a couple of calculations for it as you're kind of thinking through your taxes. One thing to point out, we talked about W-2s and 1099s. A lot of universities will pay you stipends over the course of the year, maybe several times a month, or maybe you get it for kind of semester. Remember that taxes are paid based on the calendar year, not the academic year. So you have to think about your stipend payments based on the academic year and when you're receiving them, as opposed to, the calendar year as opposed to the academic year. So the other piece is that, and I don't know exactly how Hopkins works, and there may be differences, but oftentimes if there are certain years or there's a time where you hold a teaching fellowship or a research fellowship, part of your overall income may come in the form of a salary. For example, maybe you get paid a certain amount for a course. If you're getting paid like that, that's anything that's processed through payroll, you will get via a W-2, and you'll have taxes withheld. Otherwise, most of you will get a stipend. If you're eligible for a stipend, you won't get a tax form and you won't have taxes withheld. So it's very important to remember that you want to make sure that you are allocating money on the side to cover any of those tax obligations. This is an example of a fourth-year PhD who has a $36,500 total income in a given year, where it's split between the stipend and the salary. And so going back to this question of what qualifies as expenses and how do you actually calculate that, let's take that stipend portion here. Some people always ask, how do you actually calculate, or is there kind of a worksheet of calculating and kind of putting this on your tax forms? There is, and if you Google, kind of a taxable scholarship and fellowship income form, you'll get a form like this that the IRS will give you. It's from, their publication 970, if you will. And basically what you do is you enter the total amount of your scholarship or fellowship, do a couple other things, and then line 6 is probably the most important, which is enter the amount of your qualified education expenses. So let's say you've summed up tuition, books, things like that, and those came to $13,335. What you essentially do is you net out those two items. What was your total scholarship minus the qualified expenses? And that's the part of your scholarship that's actually taxable. That's the part that you would essentially need to pay taxes on. And then you would take that $10,000 amount, and some people want to know, where does that go on the 1040? It actually goes like a little side item here on line 1 of your 1040. Line 1 has your total wages, salary, and tips. And essentially the scholarship portion, because there's no other way for the government to know, gets annotated as a little side note here. So a couple other things to note. If you have a graduate teaching fellowship, or usually an RA assistantship, that will be treated as salaried income. You'll receive a W-2, and you'll have federal and state income tax withheld. One thing to point out here that I want to kind of call out for this and any other forms. If you are receiving a tax form, in all likelihood, the government is also receiving that form. So any W-2 that you receive, if the university is sending you one, they're also sending one to the government. One of the easiest ways that the IRS checks, if people are paying their taxes is they will look by your social security number or tax ID number and say, here's what we received, from W-2 income for John Doe. And, he's claiming he only made, half of that. There's a disconnect. Let's figure out what's going on. So if you're receiving a form, you want to make sure that you are inputting those amounts onto your tax return, because the government can take a look at that. If you have a postdoctoral fellowship, or if you receive any sort of academic prizes and awards, you will likely be issued a 1099 miscellaneous tax form by the university. And this is, for postdocs, this applies whether you're funded from training grants or an outside source. And there's kind of different pieces here, but what I will call out for a postdoc, if you're receiving a fellowship, is if you're getting a 1099 miscellaneous, there's no income tax withheld. And so again, you have to budget and make sure that you are accounting for that, so at the end of the year, when you file your taxes, you have enough to make that payment. If you're working during kind of other types of wages during the academic year or summer, you may get some kind of some other tax documents. Usually it'll be a W-2 or a 1099. So one piece to call out, it used to be before 2020 that for graduate students, it was actually really hard to save for retirement. And the reason is that only the portion that was salaried, in other words, that you received the W-2 on, would count as income and could be used to kind of make retirement contributions. The Grad Student Savings Act that passed changed that. That basically said that for graduate students, compensation includes anything in your gross income. So now any stipend, fellowship, or scholarship money counts as income and can be used to save for retirement and putting money away towards an individual retirement account. This is a huge change and a really positive change that helps graduate students start to save for their financial future. One other piece on the travel expenses. Sometimes, you may travel for something that's related to kind of your program of study, and you may pay expenses and get reimbursed. There's a question of whether those reimbursements are taxable. And in most cases they are, but there are exceptions. If you can document that the reimbursement directly supported a faculty member's program, if you were presenting at a conference and then you were reimbursed, if it's integral to your work, or if it's official university business, then those reimbursements are not reportable and not considered taxable income. The integral part of a student's degree work may be a little bit of fudging. There's ambiguity there, but these give you some guidelines that can help you essentially determine whether it's reportable and taxable or not. To file taxes, if you're an international student, you're going to need a lot more information, including kind of your entry and exit dates and a lot of kind of other forms. If you are kind of a student from the US, you'll just need all of your W-2, 1099 forms, etc. For international students, again, Glacier can really help you with this, but you really need to start by determining your residency status. I mentioned the substantial presence test at the start. It's basically, looks at the number of days that you've been in the US over the past couple of years, and then determines whether you are a resident or a non-resident. To me, the easiest way is just to use kind of the tax software, but sometimes it's helpful to understand the methodology for this in case you think you want to kind of validate that what's coming out is accurate. So we talked a lot about ways of or taxes that you're going to pay. Let's talk a little bit about ways to offset some of the taxes that you pay. There's something called the lifetime learning credit. Most of these, by the way, are only available if you are a resident for tax purposes. The lifetime learning credit is a credit for graduate students. It's available for an unlimited number of years for post-secondary education. And it can basically be used to help offset additional qualified education expenses. And basically it's a tax credit of 20% of up to $10,000 of qualified tuition and fees. So in other words, you can lower your tax bill by about $2,000. You can't double dip, meaning that if you counted a qualified education expense to reduce your scholarship or fellowship, you can't also apply it to lifetime learning credit. But let's say your stipend was $20,000 and you actually had $40,000 of qualified education expenses. You could use the first $20,000 to offset the stipend, and the next $20,000, or in this case $10,000, to kind of claim the lifetime learning credit. The American Opportunity Credit is only available for the first 4 years of postdoc education or post-secondary education. In other words, it's not going to apply for most graduate students. But the reason I put it in, and this goes back to my differentiation between academic year and calendar year, if you, if you had graduated in the spring from undergrad and then started grad school right away, that first year in the fall, when you're a grad student, you would still be able to claim the American Opportunity Credit. Unlike the Lifetime Learning Credit, with the American Opportunity Credit, you can actually get a refund even if you don't owe any taxes. So again, you have to file in order to do that, but it's a really good way of kind of getting some money back, frankly. Finally, tuition and fees. You can help reduce your taxable income by these. If you owe student loan debt and you're paying interest on it, maybe from undergrad, or if you're a master's student, you can deduct up to $2,500 a year of interest on student loans. Let me walk through and kind of put this all together with an example. So let's assume Sarah is a graduate student and a US citizen, therefore a resident for tax purposes. She's single, doesn't have any children. Let's say in 2021, the year, she received $20,000 in fellowship income and $15,500 in RA income. Let me just update this to avoid confusion for anyone. Apologies, I missed that earlier. And she paid $11,000 in qualified education expenses, and she doesn't have a student loan. So let's put together some of the information we spoke about before. The standard deduction for 2021 is $12,550. There's no personal exemption. And the marginal tax brackets, we said about 10% up to 99.5, 12% on the next tranche, and then 22%. So let's tie this all together. First thing Sarah is going to do is to offset her fellowship, which is her gross income, with adjustments, qualified education expenses. So because she had $11,000 in qualified education expenses, she can net that out against her $20,000 fellowship, meaning that the taxable portion of her fellowship is $9,000. She adds that to all of her RA income, which is salaried income, and she has her total gross income or adjusted gross income of $24,550. Now, Sarah's going to take the standard deduction of $12,550, meaning that she has taxable income of $12,000. And then she multiplies each portion of that by the tax rates. So the first 99.5 by 10%, and then the remainder by 12%. And you can see that her tax liability ends up being $1,241. So because Sarah had qualified education expenses, it actually lowered her overall income quite a bit. And she owes, a fair amount of money. It's not a lot, but it's a lot lower than it could have been. So that's kind of putting all of this together, and some things that I want all of you to think about as you're going through, which is what are all my sources of income? What are the qualified expenses that I can use to reduce that income? What other kind of deductions can I take? And then let's figure out what your liability actually is. Other ways of reducing your tax liability, if you think that's still too high. I'll cover 4 different categories. Pre-tax payments. If you attended last week's session, payments made into a 401k or an IRA are made pre-tax, meaning you don't have to pay taxes on it. It's a great way to reduce your adjusted gross income and essentially owe less taxes now. You'll have to pay taxes later on when you withdraw the money in retirement, but it's a good way to lower it. Putting money into a flexible spending account or a health savings account is another great way of lowering your tax burden right now. Also, the one other one I'll call out is capital gains losses. If you invested money in mutual funds and stocks and lost money and you sold those, you can actually claim those capital gain losses to offset any gains that you have. There's a limit to how much losses you can claim in a given year. Usually it's about $3,000, but you can carry over any losses and claim them in future years. Deductions, we spoke about a few of these. Some are a bit more idiosyncratic. The rental deduction is one that only applies in, let's say, Massachusetts or maybe a few other states. And there are other ones around, home office deductions that you may be able to claim if you have 1099 income, not W-2 income. I covered a lot of these credits. And then the other one I call out that doesn't reduce your tax burden now, but reduces it in the future. We talked about 401ks and IRAs before. The Roth versions of those accounts, you put money in post-tax, but then it grows tax-free, and it can be, and you don't have to pay taxes when you withdraw it. 529 contributions. If you are saving for, your children's education, or frankly, if you have tuition and expenses that you have to pay, you could put money into a 529. And if you use that later on for a qualified education expense, it gets treated and you don't pay taxes on it. There are also some states that will give you a state tax credit for a certain portion of your 529 deductions. So even if you're going to use the money in the same year or the following year, you can save a little bit of money if you happen to live in one of the states where you get a credit for that. Finally, a couple watch-outs. If you are an international student, file the right form. If you are a non-resident, do not file the regular 1040 or the 1040 easy. You have to file the NR versions. You also have to make sure that you're filing Form 8843. If you, I would make sure that you understand if you have the benefits of a tax treaty. And if you do, make sure that you're submitting the right forms to your institution to make sure that they're applying those correctly. Audits. Some red flags that increase the likelihood of getting audited. The more money you make, the more likely you are to get audited. This is from a few years ago. It basically shows you the percent of returns that get audited based on income. And you can see quite an exponential growth. Basically, starting at 6 figures, when you start making 200,000 or more, your rate starts to go up really quickly. When you make $1 million to $5 million, 1 in, kind of 8 in 100 get audited. When you get to the $5 million mark, 1 in 5 get audited. And if you're making over $50 million, 1 in 3 returns gets audited. What I'll say on this similarly is I hope each of you are subjected to an IRS audit at some point, just based on what that likely means for you. The other thing to point out is that the lowest likelihood of an audit is not 0. If you actually claim 0, it has a higher audit rate than if you claim a little bit of income, partially because the IRS says probably should have a little bit of income. Going back, not reporting all of your income, likelihood of increasing an audit. If you have 1099 income, taking higher than average business expense deductions, and the IRS has like rules of thumb that of what they consider average, can trigger or increase your likelihood of an audit. Math errors are much less likely given the use of software as opposed to paper and pencil, but those also get you a higher likelihood of audit, and kind of others on there as well. So I point those out not to say that you shouldn't take what's rightful deductions that are rightfully yours, but to make sure that you can support them and that they're legit. Finally, I'll give you just a general kind of view on this. And this applies to a lot of graduate students. Because a lot of your income doesn't have anybody withholding your pay or withholding taxes and paying it, oftentimes graduate students will be forced to make estimated quarterly payments. And essentially that means is if on your previous year's tax return, you owed at least $1,000 in federal taxes, the government wants its money quicker. And so it doesn't want you just to wait until April of next year to pay it. It wants you to basically say, okay, you owed us a fair amount of money. We want you to calculate what you think you're going to owe next year and pay us quarterly instead of annually. Now, Glacier Sprint tax software will flag for you if they think if you think you need to pay estimated quarterly payments. And they'll actually spit out worksheets for you and vouchers to say, okay, in January or in October, here's what you need to pay. This hits a lot of graduate students, and it's something I call out that you should pay attention to. If you're filing your tax return and the tax software says that you need to start making quarterly payments, you want to make those. If you don't, you may be required to pay a penalty, and nobody wants that. And that penalty can be a 10% penalty on the money you owe and go even higher. So really important, especially for graduate students, to think about whether you need to make quarterly payments, and if you do, make sure that you actually make them. How to file. If you are a US citizen or a resident alien, my recommendation, software. I don't really have a preference on which one. I gave you a couple options here, or use an accountant. If you're a non-resident, don't use TurboTax or HR Block. You have to use Glacier or Sprint Tax or kind of one of the software providers that are specifically geared towards international students or non-residents. A couple other callouts. If you are a resident or a US citizen, there are a lot of free file ways to file your taxes for free. And that's whether with tax software or using VITA, Volunteer Income Tax Assistance, which is basically volunteers who help individuals if your adjusted gross income is below $53,000. Give you some other options in terms of CPAs or kind of national tax prep firms. If you are using a human accountant, make sure that they filed student tax returns in the past. Make sure that you get an estimated price up front, and make sure that they're willing to back you up in case you're audited. Avoid anyone whose fee is based on a percentage of your refund. That is going back to kind of my earlier slide, someone who may have conflicts in terms of how they get paid and doing the right thing. All right, for all of you here, I'm going to put this in, I'm going to put this in as just a question that came up. Hopefully some of you saw on one of the first questions, a link pop up for a Google form. That's a survey. I'm hoping you can take a few minutes right now to answer a couple of questions about what you thought about the workshop. We've updated workshops from last year based on your feedback, so think about it as a way to pay it forward. And it's really, really helpful just to understand whether this hit the mark, were there things that you'd like to see that I didn't cover, whether this really helped you as you were thinking about your taxes, cleared up any confusion. Would be really wonderful to have you fill that out. While you do that, I'm going to pause and kind of open it up for questions from anyone. I know some of you asked a few questions as we went through. Thank you. But if you have any other questions, I'd love to take them to make sure this is this is very clear for all of you and you feel comfortable with filing your taxes next year. So I will pause. Okay. Question came in. If the IRS basically knows how much we owe, is there basically a place where we can just view the balance? Great question. I wish it were that easy. It's not. In many other countries, it is. The IRS actually, or the other countries' version of the IRS, sends you basically a completed form saying, this is how much we think you earned, this is how much we think you owe. If you agree, just send us this amount. In the US, for a lot of reasons, and I'm happy to talk about some of those, we don't have that system. And basically the onus is on you as an individual to complete and file your own returns. Part of this is a lot of lobbying done by big tax preparation firms and software providers like Intuit, which owns TurboTax, H&R Block, because the thinking was if the government made it that easy, that would cut into a lot of their business model and their revenue. Is it the best answer? No, I think for a lot of us, it is actually a pretty simple calculus of how much do we owe, and it'd be great if it was all centralized. I wish it was, but it's not. Question came in, can you touch on student loan interest payments again? Can you still claim those payments if your loans are from undergrad, if they're deferred during grad school? Yeah, so the way that you, so by the way, student loan interest is kind of deferred, I believe, until January based on kind of recent Biden administration kind of areas. But if you have interest that was accruing or is accruing, let's say in 2021, your student loans, you can definitely claim any interest that is coming through as a tax deduction up to $2,500. Even if the loans are from undergrad, it doesn't matter if they're deferred. As long as there's interest, if you're paying any interest, you can claim that. Basically, if you're making payments on your student loans, even if they're deferred, you can still do that. At the end of the year, at the start of the new year, your student loan servicer will send you a tax document. Let me go up. I think I have it listed here. Let me just make sure. Give me one second. I just want to make sure I get the name of the form right. I may have taken it off. No, it's not that. I kind of took it off here, but basically they will send you a form saying, here's how much you paid in interest on your student loan in 2021, and that is basically what you would use as documentation to say, okay, even if it was undergrad loans, even if my loan was deferred, maybe I still made payments. I paid $2,000 in interest on my student loan, and therefore I can claim that as a deduction. So it can be for whatever time period your loans are from, as long as you're making payment in that year. So question came in, when an international student's tax status changes to resident, does the student start having to report income from other countries, for example, capital gains? Yes, this is one of the kind of quirks of the tax system, that once you are considered a resident for tax purposes, you're essentially taxed on worldwide income, not just income on US sourced income. So that is, it's a quirk that affects a lot of people as they become, as they've been in the US maybe for more than 5 years or more, and basically start filing and following the same rules as US citizens. It's a great question, but unfortunately the answer is you do have to report worldwide income. Question came in, if you overpay on taxes, will the overpayment come back in a filed tax return? Yes. So basically, when you file your tax return, you're reconciling how much you paid with how much you owe. And at the bottom, you're basically going to say, based on these calculations, I either owe money, or in this case, if you're saying you overpaid, it'll say, hey, I overpaid, IRS, you owe me $500. And then what you do is when you submit that, you'll also give the IRS instructions on where they should be sending that money. You can include, a routing and account number for them to send it to a checking account or a savings account. That's probably the easiest way. Otherwise, you give them an address and they can mail a physical check. Not recommended because it takes more time, but basically you would put that in, and then the IRS would process it and then remit payment to cover as basically a refund for the overpayment. So it's a great question. All right, I'm gonna hang on for a minute here just to see if there are more responses that come in. Just another plug again, if you're able to, I saw some responses come in on the survey, very much appreciate that. If you're able to, a few more of you, if you're able to complete that, would really appreciate it. Any other questions on taxes? All right. The recording and the slides will be available to you, so you'll be able to reference it back. I know we're pretty early in the year, and so it's going to be a few months until you are probably thinking about your taxes. We wanted to make sure that you could make some early take some early action against some of these, but feel free to kind of take the recording and then listen to it again in February or March as you're thinking about filing your taxes. All right, well, thank you again for taking time out of your Wednesday. Really appreciate it. And if there's any other questions, feel free to send me an email and I'd be happy to answer them.